Hey everyone, welcome back to Corporate Decoder. Today we are diving into Atossa Therapeutics annual report. And let me tell you, this one has more twist than a pretzel factory. Will they strike gold with their breast cancer drug, or will the financial tightrope snap? Let's decode the report and find out. Atossa Therapeutics, a clinical stage biopharmaceutical company, is laser focused on developing new medicines, particularly in the area of breast cancer. Their main hope is a drug called oral Z-endoxifen. They are in the middle of trying to get it approved and onto the market. First, let's address the elephant in the room, money. As of June of last year, their public float, basically the value of shares available to trade, was almost $150 million. To guide us, we have a handy table of contents. Now let's get into some important details. At Toes Frol, Itiftum One Biz and Scroll Atossa is working to improve how breast cancer is treated and even prevented. Oral Z-endoxifen, which they call their lead drug candidate, is at the heart of it all. Basically, it's like a souped-up version of tamoxifen, a well-known drug for breast cancer. Up to half the women taking tamoxifen don't get enough of the active ingredient that makes it work, and Atossa believes their drug can solve that problem. They have a few trials underway, the most important one being the Evangeline study. This study is testing the drug on women with a specific type of breast cancer before they have surgery. The initial results have led them to revise the study, focusing on a lower dose they now believe will be more effective in the long run. The second study, Charisma, is testing a low dose of their drug to reduce breast density, which is a key risk factor for breast cancer. The third study is ISPY2EOP, which is in partnership with QLHC, a healthcare collaborator. The Recustis is another trial in progress. Looking ahead, Atossa plans to explore if their drug can help with metastatic breast cancer where the cancer has spread. The market they are aiming at is huge. The global market for the type of breast cancer they are targeting could hit almost $34 billion by 2030. That being said, Defined Health, a market research firm, believes they can reach $1 billion annually on their own if approved. Keep in mind that they don't expect revenue until their programs are developed, approved, and successfully commercialized. Intellectual property is a huge part of their value, and they're working hard to protect their innovations. As of early March, they have 13 patents and over 100 applications in the works related to their drugs, immunotherapies, and other treatments. Now, let's not forget the risk factors section where they outline everything that could go wrong. This is very important in judging a company. First off, they have a history of losses and may not be able to stay afloat without more funding. In fact, they need to raise a ton of money to keep things going, and there's no guarantee they will get it. Even if they create a great product, it might not get accepted by the market. They also need to create a whole sales and marketing team from scratch, and it's a gamble whether that will work out. Plus, there's a chance they won't be able to use past losses to lower future tax bills, which would sting. Their success depends on the ability to defend their patents. They also have to be extremely careful with patient data and privacy laws, or they could face big fines and a damaged reputation. Also, they may have trouble maintaining their Nasdaq listing, making it tougher for stockholders to sell their shares. Here's where it gets interesting, the financials. Let's break down some numbers. For 2024, their net loss was almost $26 million. While high, this is actually better than the $30 million loss from the year before, 2023. They are still losing money, but they are losing less of it. Research and development expenses totaled around $14 million, down from $17 million in 2023. What's worth noting is the cash and cash equivalents are down from $88.5 million to $8.5 million to 70 their watch and $1 million. They are spending their watches to get things moving. Also, their investment in equity securities was completely written down, losing them 1.7 M as a result of the failing of Dynamic Cell Therapies Inc. Their net cash used in operating activities, the amount of cash to operate the business, was about $21 million. This is a sign they will need to raise more cash if they don't manage to get some form of revenue going soon. Looking at future obligations, they expect to pay over $10 million related to contracted clinical trials. What is important for the company's bottom line? The total stockholders' equity was around $71 million in 2024. This is down from $91 million the previous year. They are also involved in the legal proceedings with one of their patents. In the auditor's report by Ernst & Young, one critical audit matter was the accounting for research and development expenses, especially clinical trial costs because of its subjective and qualitative nature. Finally, they have a strong insider trading policy to ensure any employer is following the law, and they also provided the list of their subsidiaries now for my take. Atossa is a high-risk, high-reward play. They have potential if their drug succeeds, but they face many challenges. Their financial situation is concerning, relying on future funding. While they reduce their losses, they need cash soon or they might be in trouble. They have a strong focus on intellectual property, but face constant challenges to protect it. The key thing to remember here is that they are betting the company on one potential product. If it fails, they might not have a backup plan. The potential upside is enormous, but so are the risks. This one is not for the faint of heart. Thanks for watching, and please subscribe, like, and comment. What do you think of Atossa? Let me know in the comments below.